Well, weak demand from the slowdown in a global economy really coming to bear on the business here. Give us an assessment of market conditions you're operating within right now, because commentary today not painting much of a brighter outlook either.
Yes, we obviously did feel the effects of a slowdown in the world economy and also in terms of the uncertainty in the market. But I do think, our results, if one looks at an underlying result, we had an improved quarter in our fourth quarter on the third, and a year-on-year basis, our operating income also increased by 19%. What actually was the biggest contributor to the net loss was impairment and restructuring charges of $300 million, which we took during the year, and roughly half of that in our fourth quarter, in order to better position our business to take on markets that are expected to be quite uncertain and difficult in at least the shorter term.
Let's hone in on that restructuring then, because on the one hand you've got anemic demand that you're facing, on the other hand you've got overcapacity, and that leading to Sappi going down this path of closing mills. Just how much capacity are you looking at reining in?
I think at this point in time we believe we've done what is necessary to do. There is still some overcapacity in the European markets, but there are, in our opinion, a number of mills that are higher cost and less competitive than what our remaining mills are. So we actually feel that we've done what needed to be done in Europe. In our other markets, and particularly in the chemical cellulose market, demand remains strong, and indeed we've announced today further investment in expanded capacity for those growing markets.
You're looking at investments being directed to the likes of North America. There's a mill there that you're looking to convert. You're upgrading some of your other plants as well, specifically your Somerset mill. What kind of capex spend are you looking at?
Well, we are spending in the region of $230 million on our Gondwana plant in South Africa. $340 million in our Gondwana plant in South Africa for expanded capacity in chemical cellulose, and then a further $170 million in our Cloquet mill in the US. Both these capex spends and investments are to expand our capacity into fast-growing chemical cellulose markets where Sappi is the lowest cost and largest producer in the world.
So you've got two situations that are unfolding at the same time. You're reining in on the one hand, you're developing and enhancing capacity on the other hand. What position does it put you in when the global economy eventually turns, Ralph? Because we've got those asking the question, are you at this stage cutting a little too close to the bone?
No, I don't think we're doing that. We're seeing our paper business, and particularly graphic paper business, as a very important part of our business going forward, but it's not a growing business. It is a business where demand is in decline, and I think will continue to be in decline for some time to come. But it is a business that produces very strong cash flows and will remain an important part of our business. We, on the other hand, feel that to make Sappi an attractive company and an exciting company, it also needs to grow. And the area where we think we're best suited to grow aggressively into the future is chemical cellulose, where we are the world leader. And indeed, I think Sappi is now very well positioned not only to deal with fairly tough shorter-term outlook and economic situation, but to position ourselves very well when the economies turn up, which we know will happen. We just don't know when it will happen. And we'll be ready then to produce what we think will be very exciting returns.